Ladies and gentlemen, welcome to Q2 FY21 results conference call of MAGMA FinCorp, hosted by Emkay Global Financial Services. We have with us today Mr. Sanjay Chamriya, Managing Director and Vice Chairman, Mr. Kailash Baheti, Group Chief Financial Officer, Mr. Deepak Patkar, CEO ABF Business, Mr. Manish Jaiswal, MD Magma Housing Finance Limited and CEO SME Business, and Mr. Rajiv Kumaraswamy, MD and CEO, Magma HDI General Insurance Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Jignesh Shial, Emkay Global. Thank you, and over to you, sir.
Yeah, thank you, Aisha, and good morning, everyone. I would like to welcome the management of MAGMA FinCorp and thank them for giving us this opportunity. I would now hand over the call to Mr. Chamriya for the opening remarks. Over to you, sir.
Thank you, Jignesh, and thank you all for taking time out to attend this call. Hope you all are safe and in good health. The Indian economy has witnessed huge swings during the last 6-7 months and now seems to be emerging resilient from the shadows of COVID-related stress, going by the latest trends in the buoyant tax collection, vehicle and housing sales. And it has been significantly helped by good monsoon, continuous support from the government and RBI to maintain sufficient liquidity and boost consumption. The companies in the NBFC sector seem to be cautiously optimistic. The current focus, however, remains on portfolio quality. Most of the NBFCs have seen lower NPAs due to moratorium first and now Supreme Court order, which will see an increase in Q3 due to the post-morat behavior and once the Supreme Court order is lifted. To manage this uncertainty, significant provision buffers have been built by the companies. The collections are gradually returning to normal with 85 to 90% collection efficiency in September, and it has seen further improvement in October. Our focus at Magma during the second quarter has been on swift implementation of government support programs of ECLGS to MSME customers, the gradual opening of the fresh business disbursals in the focus products, restoring collection efficiency post-morat from September onwards, maintaining high liquidity, and maintaining the lead in OPEX reduction and cost reduction. I will now share some of the highlights with you in this respect. Over 90% of morat customers paid the September EMI. Over 96% paid at least one EMI in September or October 20. We have made additional COVID provisions during the second quarter of rupees 90 crores, and the cumulative provision on account of COVID now stands at 238 crores, which is 1.5% of AUM. Based on the portfolio behavior and the stress testing of the portfolio, we are confident that we are adequately provided for to deal with any increase in the NPA and the NCL post-morat normalization of buckets in quarter 3 and quarter 4. We expect restructured accounts under the RBI OTR scheme to remain very low and unlikely to exceed 3% of AUM as against present 0.5% as at September end. We have received excellent support from our bankers during this entire period and are quite comfortable with the liquidity position at 2,200 crores. And we have a strong pipeline of sanctions both in hand and expected. The current benign interest rate has also helped us bring down our cost of funds by 19 basis points during the quarter and 39 basis points during the first half. And we expect this trend to continue in the second half as well, with the annual reset becoming due. We have achieved significant reduction in OPEX to the tune of 70 basis points during first half and expect the sustainable savings to the tune of 40 bips, while the balance 30 bips will gradually come back as business picks up and the variable cost will go up. As a result of the above initiatives, despite additional COVID provisions made, our profit after tax has gone up by 29% from rupees 30 crores to 38 crores during Q2 and by 89% from 40 crores to 76 crores during H1. I can safely state that we have now returned to profitable path and it will improve going forward. We expect disbursements to start growing from Q3 at 70 to 80% levels and 90% levels in Q4 and touching 100% by March, and therefore exit the year in a normal state. In pursuit to realize the true intrinsic value of its three businesses, we had decided in our board meeting held on 27th August 20 to undertake three strategic initiatives to unlock value for the shareholders. Now I would like to give you a respective progress and update on these strategic initiatives. The first was a sharpened focus in MFL. So in line with our strategic decision to focus on the high ROA products like used assets, tractor, and the SME, we have stopped sourcing low ROA products like new car, new CV, and the new C. The current non-focus AUM runoff is envisaged to release equity capital of rupees 475 crores by March 22, which is 235 crores by March 21 and 240 crores by March 22. And this entire 475 crores will be deployed to grow the focus products. The resultant mix change will raise MFL's NIM, ROA, and the ROE. The second initiative was on the value unlocking in MAGMA Housing Finance. MHFL, the wholly owned subsidiary of MFL, continues to strengthen its presence in the specialized affordable housing finance. MHF has initiated actions for a capital raise process for growth. MFL shall keep investors' preference in mind while finalizing the reorganization structure for housing company. And the last one was a value unlocking in our insurance company, MAGMA HDI. Given the huge opportunity potential in the general insurance and promising prospects of MAGMA HDI, the company has received strong investor interest for participation in the capital raise process. Currently, we are engaged with few interested parties and hope to receive firm commitment in the foreseeable future. Deepak, our CEO for the ABF business, is caught up in some medical emergency today and could not join, and therefore I will share with you the progress on the ABF business. Auto sector has outperformed by 15% in Q2 on a YY basis, and particularly in September and October. Used car segment has shown a similar growth trajectory and is quickly scaling back to pre-COVID levels. This augurs well for us given that preference for the pre-owned vehicles is higher versus the new vehicles in the customer segment and the rural stroke semi-urban space that we operate in. Commercial vehicle segment, including used, have suffered the most during lockdown owing to the poor freight availability and lack of drivers and helpers. This customer segment has seen the highest stress in the cash flows and viability, as also witnessed by the high moratorium percentage. And we believe that it will take another 2 quarters to stage a full recovery. We are looking actively towards resuming disbursements in these segments basis improved on-ground cash flow situation. Tractor and the used cars are and will be the standout performer due to the quicker revival in the rural economy and need for personal transport. Following our decision to exit the low-yielding new vehicle business, I am glad to announce that our entire disbursal in second quarter are from the focus products, which will help us in building a higher ROA portfolio. While we are yet to reach pre-COVID disbursal levels, month-on-month disbursals have shown an upswing. Used car disbursals are at 75% of pre-COVID levels in line with the industry. Keeping in mind our strength in the rural space, we have structurally realigned our sales vertical into vehicle and agri finance to focus on the needs of our customers from agri and the allied activities. While there is a drop in 5% in the overall AUM versus March, our AUM in focus product has remained largely stable, and the drop was mostly from the runoff in our new asset book, which is the non-focus products. Our investment in strengthening collections structure has paid off, and it has fully stabilized in second quarter. And we are confident that it shall stand us in good stead while navigating post-morat scenario. We have achieved more than 90% collection efficiency in October and have made COVID provisions of rupees 186 crores as on 30th September, which is 1.9% of our AUM, which is sufficient to deal with any increase in the NPA during the third and the fourth quarter. For quarter three, with the onset of the festival season, we expect the demand to pick up in our operating product segments, barring medium and heavy commercial vehicles. In this respect, our drive towards digitization of our processes, as well as expansion and engagement with our channel partners, should help us in growing our market share in our chosen products and territories. On collections, the focus would be towards managing the morat portfolio, especially in the standard assets. I now request Manish to take you through the MAGMA Housing Finance and the SME business. Over to you, Manish.
Thank you very much, Sanjay. Good morning, everybody. So I'll first talk about MAGMA Housing Finance, followed by the SME business overview. At MAGMA Housing Finance Limited, we are a national-scale affordable housing finance company with focus on retail granular assets entailing fractional construction risks. The semi-urban and rural economy demand is showing sharper growth in Tier 2 and 3 towns when contrasted with Tier 1 and metro towns. MAGMA Housing Finance has demonstrated resilience and has been able to capitalize on the current opportunity presented by the pandemic when the home has become the most valuable asset. We have bounced back to 87% of our pre-COVID level disbursals and also 92% on collections. We disbursed 267 crores in the last quarter, comprising of 98% of ready and self-construction cases, and it's merely 2% of properties are the builder construction properties. Our AUM has grown by 23% year on year and now stands at 3,554 crore. Our AUM on overall mortgages vertical, if we include the LAP assets which are parked in MAGMA FinCorp, would cross 4,000 crore in the last quarter. Our Bucket Zero collections appear on track to reach pre-COVID level efficiency from this quarter itself. Asset quality is stable. Stage 3 assets at a gross level stand at 1.6%. There's improvement of 0.6% year on year. Keeping up our conservative stand, we have taken additional COVID provisions of 6.5 crore in this quarter. The total additional COVID provisions, which for the year now stand at 18.3 crores at 0.5% of our AUM. The profit after tax rose by 30.6%. My apologies, I'll repeat. The profit after tax rose 30.6%, excluding impact of COVID provision of 6.5 crore to rupees 18.8 crore against rupees 14.4 crore in Q2 FY20. Customer centricity is a way of life in MAGMA Housing Finance. Our core values remain of Go Direct, Go HL, and Go Digital. We are endeavoring to inculcate a culture of humility to serve our customers and have adopted PMAY in supporting our customers as a way of life. Over the last quarter, 60% of our freshly onboarded home loan customers are eligible for PMAY benefit. This has also helped our women empowerment at the strata for women borrowers now constitute 96% of our loan origination. We have started making inroads in our digital journey. Our LOS end-to-end digital workflow is launched in the last quarter. Our relentless focus shall remain being customer-centric and building a strong national scale franchise to serve customers with meager documentation in semi-urban and rural markets. I will now come to the SME business. The SME business took long strides in working with Ministry of MSME, SIDBI, and NCTGC to give fillip to the initiative of ECLGS, which Sanjay mentioned earlier, under the government's Atmanirbhar program to provide timely liquidity to support our micro, small, and medium entrepreneurs. Deploying the best of fintech capabilities, the SME team digitally accessed and disbursed 3,000 loans to SMEs amounting to 100 crores in end-to-end paperless and seamless process at the backdrop of 100% government guarantees. Almost 60% of eligible MSMEs who needed revival capital have been beneficiaries of ECLGS under our Go Digital SME initiative. We are exploring such collaborative opportunities to deepen our contribution under this program. The pandemic times have provided the opportunity to transform the SME business towards the Go Direct and Go Secured strategy. The product, process, policy, and training activities in line with the strategy have been completed, and the Go Secured business has gone live already in 2 states. The SME direct business model will undergo expansion and enable direct connection with customers through gradual disintermediation. In line with our agenda of supporting MSMEs to reboot their business model, the company entered into partnership with Wadhwani Foundation, a leading philanthropic institution, and has reached out to over 500 MSMEs. Under the Sahayata program, the MSMEs are being offered pro bono consulting to navigate businesses during the pandemic time with focused advisory on digital learning management, resource management, financial and revenue enhancement programs. In ensuing quarters, the company would focus on accelerating transformation over disbursements and further bolster the franchise through Go Direct and Go Digital and SME business. I would now request our colleague Rajiv to update on MAGMA LTI's performance.
Thanks, Manish. Good morning, everyone. The general insurance industry has registered a growth of 5.6% in quarter two on the back of a robust growth of 20.9% in the health segment and 16.6% in the commercial business. The motor segment, however, continued to register a degrowth in the second quarter also, a degrowth of 3.5% in quarter two vis-a-vis 23.6% in quarter one. On an overall basis, the industry has grown marginally by 1.4% in H1 of the current fiscal over last year. As a company, MAGMA HDI has grown by 3.7% in the second quarter with a strong growth of 148.9% in the health and accident segment and a growth of 45.1% in the commercial segment. The degrowth in our motor segment has also tapered from 28.2% in quarter one to 6.6% in quarter two of FY21. Our journey on empanelment and commencement of business with OEMs continued in this quarter as well. With an impressive spread of partners, the company is well poised to grow both in the motor segment and on an overall basis once the market rebounds on auto sales. Traction in the health business continued this quarter as well. The health and accident segment now contributes to 7.3% of our total portfolio. Motor is now contributing to 71% of our portfolio and the balance being the commercial segment. Our investment AUM stands at about 2646 crore as of September 30th, with the leverage being 6.1 times of capital. Our profit after tax for H1 FY21 stands at 20.7 crores as against 2.79 crores in H1 last year. Our solvency as at September 30th stands at 1.78 times. Over to you, Sanjay.
Thanks, Manish and Rajiv. And thank you all for patient listening. So now me and my entire team, we are ready to take any questions that you all may have.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. We would request the participants to please press star and 1 to ask a question. The first question is from the line of Umang Shah from HSBC Securities. Please go ahead.
Yeah, good morning, sir. Congratulations on a good quarter and thanks for the opportunity. Thanks for taking my question. Sir, I have a couple of them. One is, to begin with, if you could just throw some light on the strategic initiative for creating value in the housing finance business. are we looking at inducting some sort of a strategic partner, or would we hive it off as a separate business entity? If you could just throw some color on this, that would be really helpful.
So Umang, as you are aware that over the last several years, the affordable housing franchise has built pretty well in MAGMA, and it has been gaining strength to strength. And as of today, the total AUM in the company is about 3,500 crores, and the net worth is about 500 crores. So looking at the growth opportunity, now we have decided to raise further capital in the range of about 400 to 500 crores, which can serve the growth capital needs for the next 2 to 3 years, and the AUM is expected to then rise to about 6,000 to 7,000 crores. In this regard, now we are looking to raise capital from the independent financial investors. And so far as the separate company is concerned, we in fact would be quite open to look at the preference of the incoming investors in terms of how we should reorganize MAGMA Housing Finance going into the future. Right now, it is a 100% subsidiary. And the raising of capital is what we believe will lead to the price discovery, because right now all the capital has been provided by the parent company.
Understood. Okay. All right. That's helpful. And okay. So in terms of the management, nothing really changes. The company continues to operate as a separate independent vertical. Whether we list it out separately, that is something that the management will take a call in the future.
Yeah, so absolutely. As far as the business operations are concerned, these are being conducted on a standalone basis even now. And that will continue as it is, and the franchise will continue to serve towards the affordable segment in the tier town, which are largely self-employed, 65-70%. So that will continue as is with no change whatsoever. Perfect.
That's great. Sir, my second question is on the ABF business, where in your opening comments you indicated that the one-time restructuring is unlikely to be higher than about 3% of the overall AUM. If you could just provide some color, is there any particular geography or any particular asset class which is contributing to this, or this would be broadly kind of widespread across our customer base?
So the 3% of the AUM which I put out as the outer limit for the restructuring also is across all the three business verticals. It is not ABF alone. And as at 30th of September, the total restructured account is 0.5% of the overall AUM. And in terms of the ABF business particularly, as you know that we are into cars, trucks, construction equipment and tractors. And we have seen that the stress is more in the commercial vehicles, whereas in case of tractors and in case of construction equipment, it is fine. In case of cars, again, the cars which are used for the commercial transportation, like those who are associated with Uber and Ola, is where we see that there is a load issue, and therefore they are not able to generate enough cash flow. In terms of geographies, we have seen that because of the intermittent lockdowns, some of the states in August and September, like whether it is Bihar, Eastern UP, parts of Chhattisgarh, Karnataka, some part of Maharashtra, they got impacted. And now, in fact, all the states, and if I tell you about 300 branches, and we get a report on a daily basis, hardly 2 or 3 branches are the ones which would be closed. Otherwise, all the branches are functioning for the last month and a half or so. In terms of the segment which I spoke to you about, I see particularly in Karnataka and NCR, where we see that commercial use of the cars for the taxi purpose or being associated with independent providers, aggregators like Uber and Ola, is where we see a certain stress which is more than the other geography. And in terms of commercial vehicle, it is more pronounced in the medium and heavy commercial vehicles, and it is more or less all over. It is not restricted to a particular geography.
Oh, great. Thanks for that. My next question is to Manish on the SME business. If you could just give a little more detailed color in terms of two things. One is obviously we keep on hearing about kind of increasing stress in the SME segment. Clearly, they are kind of most impacted. Particularly with your portfolio, is there any particular segment, again, within your overall portfolio which is impacted relatively higher? And second, in terms of fresh underwriting or new customer acquisition, how are we looking at underwriting new customers, and what changes we would have made in our underwriting process, if at all? Thanks.
Thank you for that question. I think I would just request you to focus on the slide number 35 and 36 of the investor deck. One very important strategy which we had very consciously embarked in the SME business was to have ring-fenced our portfolio, which today largely comprises of unsecured loans. And it is ring-fenced to 80% under the government guarantee schemes. And I would say that we have done a good job of not only covering ourselves well, but apart from this, we have also been able to run this business basis the industry cluster and segmentation, which has come very well. So there is approximately, I would say, a large 3/4 quarter of our business, which is actually not so been badly ravaged by COVID, so to speak. We already see green shoots coming in from the SME customers. For example, to give you a data point, in our bucket zero collection efficiency in the month which just went by, we are very much close, almost bouncing back to normal, probably could be short by 2% odd. But we feel that that SME business, perhaps now that the markets are coming back, if we stay focused on the reviving sectors like the chemist, grocery, engineering, healthcare, pharma, agri, food, electronics, and all of that, we feel that if we segment it well, there will be opportunity. There will be certain segments which will catch up later, but I think what's going to be very, very important in the segment selection. And at the same time, I've also mentioned that we have taken strategic steps in the business to move from completely unsecured to secured, from completely franchise-based to going direct and going digital. Perhaps we can say SME business today in Magma is an NBFC tech organization, and we can actually do a loan end-to-end completely digitally. So I hope that answers your question.
All right, sure. And just one data keeping question. What would be the cumulative sanctions and disbursements under the ECLGS scheme that we would have done?
So I'll tell you at a high level, we have 15,000 customers. 6,000 customers would overall qualify. We have already disbursed loans to over 3,000 customers, which means that we have struck efficiency of 50%, could be the highest or the best in the industry. Possibly, given that the extension till October, we might see another 1,000 customers coming in the fold. But by and large, whoever had to be served and needed revival capital have been serviced.
Okay, so you were saying that roughly about 3 out of 15 have been served, and maybe another 1,000 can potentially
I must qualify those who were eligible were only 6,000, because government had also put conditions. Basis those conditions, the ones which were eligible and putting our filters where we felt they should be looked at were only 6,000 customers, because there are also a lot of do's and don'ts on who to not offer ECLGS to. So the ones who could qualify are only 6,000 customers.
And I'm assuming that on value terms, the broader percentages would remain the same.
True.
All right. Thank you so much, and wish you all the best. Thanks.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and one now. The next question is from the line of Bunty Chawla from IDBI Capital Markets. Please go ahead.
Thank you, sir. Thank you for giving me the opportunity. From the provisioning part, as we have seen, there has been a COVID provision of approximately 1.5% of AUM by H1 FY21. And if we go with the numbers which you have given on the collection, at least 4% book has not paid a single EMI. So how should we see this provisioning going in H2 FY21? Because you have already declared that at least not more than 3% will go under restructuring. So how this provisioning will pan out in second half of the year? And secondly, on the provisioning part, we have seen that gross 3-stage assets, or you can say coverage ratio, has increased from 35 to 38%. So how we should see this coverage ratio on a sustainable basis?
So, Bunty, I think you have asked a number of questions, and this is one of the most important areas which is receiving attention by all the companies in the sector. So let me try and attempt it in different parts. One is, out of the total 15,500 crores AUM, about 600 crores, 595 to be precise, which is 3.8% of the AUM, where the customers haven't paid EMI after the moratorium has been lifted, which is in 2 months, September and October. And we feel that compared with the other players in the industry, it is a fairly good performance by MAGMA. Second, now opposite to this, we have given restructuring only to 0.5% of the AUM. And we expect that it is unlikely to cross 3%. So maybe some part of these customers who haven't paid, if they are genuinely cash strapped, and if we find that the asset is there and the loan to value is not negatively impacted, we may grant some of these customers restructuring option. So therefore, some will get addressed from that. Then we have a COVID provisioning of about 238 crores, which if you calculate on 600 crore worth of these customers who haven't paid EMIs in September and October, then we almost have 40% which is covered under the COVID provision. This COVID provision of 238 is over and above the normal provisioning in stage 1 to stage 3 assets. So we as a management team also carried out a stress test scenario on our entire portfolio, that depending upon the position as on 30th of September, how will this pan out in the second half of the year? And there we found that even in the worst case scenario, we are adequately provided in terms of the provisions, and we therefore should not seek an undue spike in the NCLs in the second half, third or the fourth quarter. And the last point that you mentioned about the PCR, which is increased from 35 to 38, I think it may stay there for even beyond March, till the time the COVID scars are fully removed. We don't want to be in a hurry to roll back some of these provisions. Even if you look at in slide 18, the stage 1 and 2 provisioning coverage, that also has actually improved by about 40% from 2.2% in March to 3% in September. Some of these provisions may get released because this is stage 1 and 2, and we have put certain enabling conditions that only on normalization of collections can we roll back some of these provisions. So all in all, we are following a cautious and a prudent policy with regard to the provisions that we have created, the utilization of the provisions and the release of the provisions.
Thank you, sir. That was very helpful. Just one clarification. You said that COVID provisioning, which is is this a part of ECL provisioning total? Is it part of altogether different on the balance sheet?
So we have 3 kind of provisioning. One, you have ECL, which is stage 1 and 2. Then you have PCR, which is stage 3. And then you have a special COVID provisioning, which has been done by all the companies in the last 6 months. If you go to that slide, I think slide number 18, slide 18, there you will see that we have also given the total provisioning, which is inclusive of stage 1, stage 2 and 3 and COVID. Then we are sitting on 4.8% provisioning of the total assets, and which we believe is by far one of the highest in the industry, and going by our bucketing and the percentage of customers who haven't paid any installment, which is 3.8, this is quite sufficient.
Okay. And so secondly, on the liquidity part, how we are how much is we need to refinance the borrowings? How much liquidity need for that requirement? If you can share that for Q3 as well as Q4.
Kailash, over to you.
Yeah. We do not have significant repayments in the next 2 quarters. Maybe both quarters taken together could be about 1,200 odd crores. So that's about all. And as you know, we have 2,200 crore rupees of liquidity right now. 800 crore rupees of liquidity which is waiting to be drawn, and we actually have quite a lot of pressure from the banking system to withdraw on the lines which have been sanctioned to us. We are actually going slow on applying for new lines. So that's the situation right now, pretty healthy situation as far as liquidity is concerned.
Okay, sir. Lastly, on as you have written in the presentation, as the normalcy occurs, there will be a disbursement. How do you see October and November month? Are we seeing any normalcy starting or picking up in the disbursement?
So this question I will take up. The dispersal, we are seeing that so far as affordable housing, so far as used assets are concerned, this has already reached between 80 to 85% levels pre-COVID in the month of October also. And we feel that in the third quarter, they may reach at about 90% plus. So far as the SME business is concerned and the commercial vehicle business is concerned, there we feel that it will take a little more time. In case of SME, we are cautious, and vehicle business also, commercial vehicle business, we are cautious. And once we see that the cash flows have started improving and the customers have deployment, so that, as I mentioned in my opening comments, that we hope that overall disbursal in the third quarter could be between 70 to 80%, and in fourth quarter it could overall reach 90, with March touching 100. So therefore, we exit the year with the normal disbursal situation compared to pre-COVID.
So lastly, sir, can you share any AUM guidance, AUM growth guidance for FY21 and if possible 22?
So we have seen that there is some degrowth which has happened in the first half of the year. As we mentioned even earlier in our guidance, our focus was more on maintaining the portfolio quality and profitability by keeping the operating cost low and reducing the cost of funds. So I think having put that behind now, and our AUM is degrown by I think about 400-500 crores. So in third quarter also there may be a slight degrowth in the AUM, but the fourth quarter is when we'll start seeing the AUM flowing back and start growing again. So if the situation, what I said, pans out and between 70 to 80% disbursal in the third quarter and around 90% in the fourth quarter, we should probably end the year at the same AUM as we started the year. And then next year is when we will look at growth.
Thank you. Mr. Chawla, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Pradeep Agrawal from Phillip Capital. Please go ahead.
Yeah, hi, sir. So I have a couple of questions. One is with respect to ABS business. So while used vehicle category has seen significant improvement in disbursements and almost at par with pre-COVID levels, so would like to understand any specific vehicle category in this used vehicle segment which is driving growth, and or it is spread across vehicle categories. That's my first question.
So as I mentioned that used commercial vehicle also the traction is less, and we are also more cautious there. Similarly, in the passenger cars, in the vehicle segment which is used for the commercial application, also we are very cautious because we are seeing that there is a excess supply. The offtake is lower. So the disbursals are largely happening in the passenger car for the personal transportation, in the used tractors, and in the construction equipment. So while at an overall level in used we have reached the pre-COVID levels, but to your question specifically, the growth that we are seeing is coming in from the cars for personal use, tractors, and construction equipment. And the growth has tapered off, and we are also cautious in terms of commercial vehicles and in terms of the commercial use of the passenger cars.
Okay. So what would be, in your sense, in your interaction with customers, would be the utilization level in commercial vehicles? Has it improved or declined versus pre-COVID or say last 6 months? Any broad sense?
Sorry, can you repeat your question? I didn't get it.
So would like to understand, the utilization level for your CV customers.
Okay.
Has it changed versus pre-COVID level significantly, or it is broadly in line?
No, of course it has changed pre-COVID to now, and like we did 2 surveys, one in the month of April, May, the other in the month of July, August. Now I think is the time to do possibly a third survey, and we covered more than 3 lakh customers across different geographies. And there we found that in August, about 60% of the customers were the ones who had deployment. 40% customers did not have enough deployment. And even those 60% had a deployment in the range of 60 to 65%. I'm sure the scenario has improved thereafter because we also see the collection efficiency having improved in September and October. Like in October, in our vehicle finance business also, we crossed 90% collection efficiency and 84-85% in the month of September. So there is an improvement which has happened. And what I hear in the month of October, in the last 2-3 weeks, there has been some traction in the light and the small commercial vehicle segment. But so far as the medium and heavy is concerned, I think it is still maybe 1 quarter or 2 quarters away. So I will not be hazarding a guess that whether the markets will revive immediately in the third quarter for the medium and heavy commercial vehicles.
Okay. Another question on your insurance vertical. So, while you have mentioned value unlocking in the insurance subsidiary in your presentation, so if you can, just give your thought on that, how that value unlocking is happening and what's the stake we are offloading. So some broad sense on that. This is to Rajiv.
Yeah. So Rajiv maybe like to take the answer.
So as we've been reporting, we've been over the last 18 to 24 months building up a fairly strong franchise on the retail distribution side. And with 83% of our business coming in from retail, the objective of the capital raise is to, now raise capital to make sure that we are adequately capitalized for the next phase of growth, which should be sufficient for the next 2 to 3 years. So as part of this process, the endeavor is to raise anything from 350 to 500 crores of capital, which directionally should help us reach about a 3,000 crore GWP in the next, I would say, 2-year horizon. And there is, also a regulatory requirement from a group perspective to bring down the stake. So we are open to any kind of constructs right now. The primary objective, obviously, is to make sure that the capital raise that we achieve is about 350 crores.
Okay, good. That answers my question. Thank you so much. Yeah, that's it from my side.
Thank you. The next question is from the line of Nidhesh Jain from Investec Capital. Please go ahead.
Thanks for the opportunity, sir. So firstly, on the ROA tree, if I look at from Q1 FY21 to Q2 FY21 pre-COVID, has been a smart improvement in ROA from 1.5% to 2.7%. And if I see it is largely driven by margin improvement from 6.8 to 8%. So what has drove that significant improvement in margin in just 1 quarter?
So I would like to bring one fact to your attention, which is that from the month of March until August, we were under moratorium, and therefore there was no roll forward or roll backward. Most of the customers had opted for moratorium. So when there is no roll forward, roll backward, you do not have credit loss. The credit loss still comes only because there may be some settlement, some repossession stock you may have disposed of, or MAGMA follows a very aggressive write-off policy where all the ABF contracts are 100% provided and also written off at 730 DPD, and SME contracts are provided and written off at 450 DPD. So these are the 4 reasons due to which we may have had the credit loss, but that would be significantly lower than the loss we would have when everything is open and when there is roll forward, roll backward happening. So this is the reason the profit before tax is higher in quarter 2 and quarter 1, significantly higher. We have made significant amount of COVID provision because we do feel that the portfolio which has moved forward in the month of September, and we have given covered this in fair detail in our presentation, 1,497 crore rupees portfolio moving to being part of the portfolio where the customers taken moratorium and did not pay in September, and then it's coming down to 595 crore in the next month, which is October. So we have made significant amount of provision there. You could also say that the COVID provision plus normal provision is what, if this situation was normal, should have been in the same range. So we would encourage you to look at our performance post-COVID provision and not pre-COVID provision. We would also like to say, and Sanjay has already mentioned this, that we see that we have adequately provided against the stress which has built up due to the COVID.
So I'm trying to understand what will be the steady state ROA for us in a non-COVID environment. For example, for FY22, should I look at a normalized ROA of 2.7% or should I look at normalized ROA of 1%? If you can guide there. And similarly, what could be the normalized credit cost and NIM? That would be helpful, sir.
So I would say that for the current year, you should be looking at the post-COVID results which we have given. That should give you a fair indication. And this is given in our slide 13 with key financial metrics. And the normalized credit loss will be in the range of about 2 to 2.5% annualized.
Sure, I'll just add on to what Kailash has mentioned. The increase in the NIMs between Q1 of last year to the Q1 of this year is basically on account of the reduction in the cost of funds. As we mentioned also that our cost of funds has gone down by about 40 basis points. The second kicker in the profits have come in basically from the reduction in the OPEX, which also has gone down by about 70 basis points. So between the OPEX and the cost of funds, the reduction, the saving is about 1.1%, which a 25% tax rate results in a post-tax improvement at a ROA level of about 70 to 75 basis points. We have also said that in my opening commentary that out of the 70 bits improvement in the OPEX, about 40 bits is what we expect to be the sustainable structure in view of the structural changes that we have done. And 30 bits is what will come back as the business normalizes and the variable cost goes up. On the other hand, we have also said that our cost of funds will further go down looking at the benign interest rate environment and also the annual reset of the interest rates coming up in the third and the fourth quarter. So we would hope that the inching up of the cost of the OPEX by about 30 bits as situation normalizes may be offset by the further reduction in the cost of funds by about 30 bits, and therefore the overall saving of about 1 to 1.1% that we have achieved should be here to stay. So therefore, right now our focus is one, to maintain, preserve capital, ensure that we don't have any spike in the NCL on account of portfolio coming out of the morat in third and the fourth quarter, and out of 238 crore of provisioning on account of COVID that we are carrying, we would like to carry some COVID provisioning even for FY22, such that in FY22 we don't have any scars of the COVID on the credit loss scenario. So that what Kailash mentioned, that it should be in the ballpark range of about 2 to 2.5% in terms of the NCL, we stay in that. As regards the specific guidance for the ROA for FY22, we would rather like to give it at the end of the year than to give it right now.
Sure, sure. And so secondly, in the disbursement mix, the share of tractors has not changed on a YY basis versus what we understand that tractor as a segment has shown very strong growth in Q1 and Q2. So any particular reason for us we have not seen that growth or we are cautious on that sector? Or?
No, it is just that we are resetting our focus on that. Used is where we set it up about a year ago, and there we have seen that we have already returned to the pre-COVID levels. And so far the tractor are concerned, from quarter 3, which is from this quarter onwards, we should be able to see good traction. And we have also done a lot of cleanup exercises because, as you know, half of the tractors are used for commercial applications and the half of the tractors are used for agri applications. And therefore we are having a micro market strategy in terms of our focus coming in from the 6 large states in India where the tractors are sold, and we have now created a separate agri team within the ABF team, which will focus only on the tractors, such that they can intensify the relationship with the tractor dealers and the channels, and we can get better counter share.
Sure, sir. On the housing finance, sir, what is our aspiration ROA and ROE there? Probably in FY22 or over a medium term?
So we believe that I don't know why I'm hearing my voice echoing. So we believe that housing ROAs currently are already in the range bound around at 1.6, and we see that our cost of funds has been relatively higher vis-a-vis other players, and it's begun to come down significantly. We see that in the long horizon, not very long, probably in about a year, a couple of years time, as things kind of reach momentum, we should be able to improve our ROAs about 100 basis points more.
Thank you.
Yeah, again, just to add on to what Manish has mentioned, we are looking to raise capital in Magma Housing. With that, the leverage would go down and it will improve the comfort of bankers, and the cost of funds should come down. As Manish mentioned, that our cost of fund is higher, and so we expect at least about 40-50 basis point improvement in the cost of funds next year. In terms of the OPEX, again, in the housing business also, while we are operating efficiently, but with the increase in the size, we expect another 20-25 bits reduction in the OPEX coming in next year. So between the cost of funds and the OPEX, about 60 to 70 bips reduction in the cost overall ROA that we should be expecting at a pre-tax level on account of these two things. And then over a period of time, it will only improve with the operating efficiencies kicking in, and as the portfolio grows from the current 3,500 to about 6,000-7,000 crores in the next 2 to 3 years time frame.
Thank you. Nitesh, we would request you to please come back in the question queue for any follow-up questions, as we have several participants waiting for their turn. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, good morning, sir. Firstly, in terms of the stance of stopping to source any of the products, particularly on the non-focus segment, so how long are we expecting it to continue? And then how should we look at this non-focus AUM to behave? So will that rundown be continuing, or this is just a near-term interim strategy which is there?
So thanks, Kunal, for the question, and hope you are doing well. And so far as the non-focus product is concerned, first of all, this strategy is a long-term strategy and not an interim strategy. And this we have taken after evaluating last 5 years trends in terms of the NPAs, in terms of the margins, in terms of NIMs, and therefore the ROA in respect of these products. So that is one. So it is not going to get reversed in the near future.
So just clarify. So in terms of cards, CV and CE, we will not be sourcing new loans out there. So would it be fair to assume so disbursements were zero, and this is what we should anticipate it going forward as well?
That's right. Absolutely right.
Okay. And so this 30% of AUM bucket which is there, that will keep on running down also with the repayment.
That's right.
Okay.
And which is where,
yeah.
So let me, Kunal, let me try to give you a slightly, detailed answer on this. So maybe some of the questions that you are having in your mind may be actually answered automatically on this, and then you can ask me follow-on question.
Sure.
So you see, this portfolio is now under 5,000 crores. You can see in slide number 31 that it is at about 4,400 crores.
Yeah.
And we have about 700 crores worth of capital which is blocked into this. We have done an estimate that total, and we are giving the near-term outlook, which is by March 21, 230 crores of capital will get released, and by March 22, another 240 crores of capital will get released. That means in the next 18 months time frame, total of 470 crores of capital will get released, and this portfolio will come down very significantly. And the second question is that the AUM, what happens to the AUM? So we are now building up growth on the focus products, which are giving us the higher yield and the higher ROA adjusted for the NCL, that is the used assets, tractors, and the SME. And we have got our engine, which is now working on that. So therefore, any fall in the AUM due to the runoff of the non-focus products in about a quarter to two will start getting offset by the disbursals that we will be doing in the other products. Such that overall what we want to position MAGMA FinCorp is as a micro and a small enterprise lending outfit. So all the lending that we do should be to the MSEs or to the farmers, and which are all absolutely the priority sectors defined by the Government of India and by the RBI. And all the products that we do also would qualify for the priority sector so far as the banking system is concerned. This is what our strategy is.
Sure. So then, when last time we were doing this entire consolidation exercise, we have graded the branches maybe according to, again, the overall pricing, the asset quality behavior. So was there anything that was indicated that suddenly we got into this strategy? Because even within the non-focus products, we were doing it from a better graded branches. So what actually led to this decision? Because we have a strong hold even on the car, CV and C. So what actually led to this shift in strategy?
Two things happened in the last 18 months, if you see. In fact, almost 2 years, from October 2018 until September 2020. In these 24 months, the commercial vehicle sales have fallen almost every single month. And this has happened due to the lower freight availability, lower load utilization, and it has created a lot of stress in the industry. As a result, what has happened, the financiers, NBFCs and banks, which are completely CV focused, the prices have dropped very significantly. So even for a first-time borrower or with a 1 or a 2 vehicle owner, the pricing has dropped to about 11 to 11.5%, whereas we used to do the lending at about 13% plus. Today, if you do a lending at 13% plus, it results in an adverse selection of customers. So therefore, we found that while we did the branch grading, we also introduced the trigger system based on the early warning indicators, that is EWI, you would remember all of those things. We found that you are either not able to do business, but if you do business, then you have adverse customer selection. And therefore, we felt that this segment is best catered by the banks or the companies which have lower cost of funds. Given our positioning, and over the last 2 years itself, we have been improving and growing our used assets franchise. And there we found that the prices have held firm, and we have also got a sufficient hold in the finance of the used car market and the used tractor market, and therefore we are growing that franchise. So this is one region. The second region is in the COVID. While the other markets have revived, whether it is the tractors, whether it is used assets, and even construction equipment, not in terms of sale of new, but in terms of the deployment of the existing construction equipment. But in respect of commercial vehicle, we are finding that it is still going through a stress. And this, therefore, we feel that is not the segment, especially the new commercial vehicle, that we would like to operate in. So these are the two reasons as to why then we decided to take this call. And we also then look back for the last 5 years, even when we did all of these things, as to in the best of the years, what was the ROA, what was the ROE that it was producing. And then we found in order the ROE, these product segments we would not like to cater.
And how does the operating structure change because of this? Because maybe both of them are quite different ones in terms of the entire operational aspect as well. So what is the kind of rationalization which we can see? Because doing cars, CVC, and doing tractors, used vehicles, affordable housing, the operating the structure would altogether be a different. So then how are we bringing, or how are we trying to rationalize this at the lower level and the middle level as well?
So this actually had been done even earlier. So you know that we have two CEOs who are managing the business. So we have Manish, who is managing the housing and the SME. And we have Deepak Patkar, who took over as the CEO in February 20. to manage the ABF business. Now, within ABF business, we have the used assets and we have the agri, which is tractors and the allied agri flows. So in order to bring in that desired focus and a deeper presence, within ABF, we have created the dedicated team for the agri business, that is sourcing of the tractor and the allied agri term loans. And so far as the used assets are concerned, which is whether it is passenger cars and trucks and construction equipment, is being done by one team. And we also have now brought in a chief business officer reporting into Deepak as the CEO, while Mahendra Bagrodia, you might be aware, is the chief credit officer. So these are the two people who report into the CEO. So we are adequately capacitized, and even at the lower and the middle level, the next question that you put up, in housing and SME, we have a dedicated sales, credit, and the collections team, which is taking care of the housing and the SME business. Similarly, in the vehicle and the tractor finance business, the credit and the collections team are separate. The sales team has been further segregated between the used assets and the tractors. So therefore, and there are certain markets, like in case of tractor, as I said, we propose to do this in 6 leading states in the country. So therefore, that particular business will come in from the 6 states, whereas we are doing business in over 20 states so far as the balance used assets are concerned. So the structure remains in that nature.
Sure. And that's why the branch rationalization is continuing, particularly on Maharashtra, Gujarat. We have still like lower number of branches and the branch rationalization as well. So this is a part of the strategy.
Yeah, about 12 to 15 branches. We actually merge them with the nearby branches to get the operating efficiency. So total now we have about 290 plus branches as at the end of September. Because you see, in COVID times, every company worth its salt, every institution has looked at every single item of cost to see as to what is it that is sustainable that we need to cut out, and also cut out the businesses which are either loss-making or which are not adequately profitable in the normal steady state scenario. So based on that, we did a micro market level analysis and looked at which market, which product we want to remain present. One advantage, of course, that we have is out of this close to 300 branches, the infrastructure is shared by the vehicle finance, the SME, housing, and the insurance business. And the cost is also accordingly apportioned between all the businesses depending upon who is utilizing proportionately how much.
Sure. Yeah. Thanks a lot and all the best. Yeah. This is helpful.
Thank you. Thanks.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 now. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
I think I thank everyone for having joined this investor call that we have had in the morning during the market hours, and wish you all the best. Stay safe, stay healthy, and we look forward to connecting with you after the end of the third quarter. Until then, goodbye.
Thank you. On behalf of Emkay Global Financial Services, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.